You've been told that a 401k is your ticket to a wealthy retirement. But here's a shocking fact. The average 401k balance for people aged 55-64 is just $256,000. That might sound like a lot, but spread over 20-30 years of retirement, it's barely enough to live on. At a 4% withdrawal rate, that's only $10,000 a year. Not exactly the dream life, right? Here's another surprising stat. Fees in your 401k could be costing you $138,000 over a lifetime. Wall Street is taking a cut of your hard-earned money, and most people don't even realize it. Even worse, taxes on your 401k withdrawals could reduce your nest egg by 25% or more. Ouch. In this video, we'll reveal why a 401k alone won't make you rich. We'll dive into hidden fees, the slow growth of compounding, and how to avoid the tax traps. Most importantly, we'll explore smarter ways to build wealth beyond the 401k. If you've ever wondered if there's a faster, better way to grow your money, stick around. You won't want to miss this. Chapter 1. The 401k Illusion. Breaking down the myth. Most people think a 401k is the golden ticket to a cushy retirement. It's promoted by employers, financial planners, and even the government. But is it really the key to wealth? Not quite. The truth is, 401 kiloseconds are designed for retirement security, not financial freedom. There's a big difference between the two. Let's break it down. The average 401k balance for someone nearing retirement age, 55-64, is around $256,000. Does that sound like enough to live on for 20-30 years? Not really. Even if you factor in compound growth, 401 kiloseconds usually don't produce life-changing wealth. In fact, at an average return of 7%, you're looking at about $17,000 a year in income. That's far from a millionaire lifestyle. Plus, 401 kiloseconds come with limitations. Contribution limits are capped at $22,500 a year as of 2024. While that might sound like a lot, it pales in comparison to the wealth-building strategies of the rich. Many high-net-worth individuals prefer to put their money into stocks, real estate, or even starting businesses, areas where they can control their returns. Legendary investor Warren Buffett once said, "You do not need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ." This quote highlights the simplicity of smart investing outside traditional methods like a 401k. It's not just about throwing money into an account and waiting for it to grow. Chapter 2. Why compounding won't save you. The slow lane to wealth. We all know about compounding. Einstein even called it the eighth wonder of the world. But here's the thing. Compounding alone won't make you rich if your money isn't growing fast enough. In a 401k, compounding works, but at a snail's pace. That's because most 401k plans are tied to index funds or mutual funds that grow modestly, around 6-7% per year. Here's an example. If you start with $10,000 and add $5,000 a year at a 7% growth rate, you'd have about $150,000 after 20 years. Decent, but nowhere near life-changing. This is the slow lane to wealth. Compare that to value investing, where smart investors like Benjamin Graham or Seth Klarman look for undervalued companies that can return 10-20% annually. Now that's the fast lane. One of the greatest value investors, Charlie Munger, once said, "The big money is not in the buying and the selling, but in the waiting." He's not talking about waiting for your 401k to grow over 40 years. He's talking about waiting for great opportunities to invest in undervalued companies and watching your wealth grow faster than average. The takeaway here is simple. While compounding works, it needs to be paired with smart investing in areas that outperform the average. Sticking to a basic 401k might mean your money is compounding at a rate that's too slow to make you wealthy. Chapter 3. The Tax Trap. What they don't tell you about your 401k. Here's a dirty little secret about 401 kiloseconds. You're not avoiding taxes, you're just delaying them. Sure, 401k contributions are tax-deferred, meaning you don't pay taxes on the money you put in today. But when you retire and start withdrawing that money, you'll be taxed at your ordinary income rate. Let's say you retire with $1 million in your 401k. That sounds great, right? But if you're in the 25% tax bracket, you could lose $250,000 to Uncle Sam when you start pulling out funds. That's a big chunk of change. And guess what? If tax rates go up in the future, which is likely, you might end up paying even more. Contrast that with investments like Roth IRAs or certain types of real estate, where you can structure your income to be tax-free or taxed at lower capital gains rates. These alternatives can allow you to keep more of your hard-earned money. There's a quote from The Millionaire Next Door by Thomas Stanley and William Danko that says, "Wealth is more often the result of a lifestyle of hard work, perseverance, planning, and, most of all, self-discipline." That planning includes knowing how to reduce your tax burden, which many 401k holders don't think about. Smart investors consider tax-efficient strategies that allow them to build wealth while minimizing the tax hit. Using things like municipal bonds, real estate depreciation, or even life insurance policies can help you shield your money from taxes in a way a 401k never could. If you find this content valuable, don't forget to subscribe for more insights and strategies to build your wealth. Chapter 4. Hidden Fees and Wall Street's Cut. Are you funding their retirement? One of the biggest secrets of 401 kiloseconds is the hidden fees lurking beneath the surface. You may think your retirement money is working hard for you, but a significant chunk could be quietly siphoned away by fund managers, brokers, and even your employer's 401k plan provider. The average 401k plan has fees that range from 0.5% to 2% annually. That might not sound like much, but over time, it eats into your returns. Let's break it down with some numbers. If you have $100,000 in your 401k and the fees are 1.5%, that's $1,500 a year gone. Money you could have reinvested. Over 30 years, that can add up to hundreds of thousands of dollars in lost growth. John Bogle, the founder of Vanguard, once said, "The miracle of compounding returns is overwhelmed by the tyranny of compounding costs." Bogle was right. Fees compound just like returns, but they're working against you, not for you. You might not even see these fees because they're often buried in the fine print of your plan documents. A 2018 study by the Center for American Progress found that the average worker loses $138,000 in retirement savings to fees over a lifetime. That's a staggering number, and it's all money that goes to Wall Street, not into your pocket. So what's the alternative? One solution is to invest in low-cost index funds or ETFs on your own. These investments have fees as low as 0.03%, compared to the 1% or more that many 401k plans charge. Another option is to invest in individual stocks, where you're not paying an ongoing management fee at all. The key is to minimize what you're paying to others, so more of your money works for you. Chapter 5. Real wealth is built in bear markets. Here's how. Most people panic when the stock market drops, but savvy investors see it as an opportunity. The real wealth builders understand that bear markets are where fortunes are made. Warren Buffett has famously said, "Be fearful when others are greedy, and greedy when others are fearful." What he means is that during market downturns, great companies are often available at a discount. When you invest through a 401k, you're usually tied to market averages, so you're not positioned to take advantage of these drops as much. But value investors know that when prices drop, the potential for outsized returns goes up. For example, in the 2008 financial crisis, the S&P 500 dropped nearly 50%, but those who bought strong, undervalued stocks saw incredible gains in the following years. In fact, by 2013, the S&P 500 had fully recovered and gained over 60% from its pre-crash high. The key is patience and having cash ready to deploy when the market is down. Legendary investor Benjamin Graham, author of The Intelligent Investor, advised buying stocks at a discount to their intrinsic value, especially during downturns. This strategy, known as value investing, allows you to buy low and sell high, increasing your returns exponentially compared to riding out the market with a 401k. A 401k doesn't give you the flexibility to pick individual companies or capitalize on big drops. Instead, consider setting aside some funds for a self-directed investment account where you can choose undervalued stocks during bear markets. Timing the market is difficult, but buying quality assets when they're on sale is a strategy that has proven to build wealth time and time again.